price pressure, policy panic, and a precious metal pullback that looks painful on the surface but hides a powerful signal underneath. Gold is falling, fear is rising, and the market is once again mistaking short-term stress for long-term stability. Right now, gold is trading at $4,200.82, down 0.82% today on June 12th, and on track for a weekly loss of 2.8%. That is its worst weekly performance in months. Silver is sitting at $67.33, and over the past month, it has dropped sharply, down roughly 23%. The headlines are loud, the sentiment is shifting, and the story being sold to you is simple. Inflation is back, rate hikes are coming, and precious metals are under pressure. But that simple story is exactly where the danger begins, because this is not the first time we have seen this pattern, and it has never ended the way the headlines suggest it will. Here is where this gets serious. Inflation in the United States is not cooling, it is climbing. The latest consumer price index for May 2026 came in at 4.2%, the highest level in 3 years. And even more concerning than that headline number is what sits behind it. The producer price index, which tends to lead consumer inflation by several months, surged to 6.8% year over year. That is not a minor data point. That is a forward signal. It tells you that the inflation consumers are feeling today has not yet caught up to what businesses are already paying. The pressure in the pipeline is still building. When inflation strengthens like this, markets do not wait around. They immediately begin pricing in more aggressive central bank action. And right now, there is a 68% probability that the Federal Reserve will raise rates again in December 2026. That single expectation, that one shift in the market's rate outlook, is the primary force pushing gold lower today. The logic on its surface seems clean and convincing. Higher inflation leads to higher rates. Higher rates increase the opportunity cost of holding non-yielding assets like gold. So gold sells off. Case closed. But that is only half the picture. And the half that gets left out is where everything important actually lives. My name is May, and this is The Untold Empire, the channel where we track shifts in the global financial system before the headlines catch up. And today we are looking at why this sell-off in gold is not a warning sign. It is a setup, not a breakdown, a build-up. Because when you zoom out far enough, the pattern becomes impossible to ignore. Every time markets begin to fear aggressive rate hikes, gold sells off. It happened in 2018. It happened again in 2019. It happened in 2020, and once more in 2022. And every single time, without exception, that sell-off marked the beginning of the next major move higher in gold, not the end of it. Why? Because rate hikes in a heavily indebted system do not actually solve inflation. They stress the system until something breaks, and the moment something breaks, everything reverses. Let me connect the dots so this picture is fully clear. The United States is currently carrying $39.2 trillion in national debt. That number is not just large in isolation. It is larger than the entire U.S. economy itself. And as interest rates rise, the cost of servicing that debt rises with them, rapidly. Projections from the Congressional Budget Office show that by 2036, interest payments alone could consume 30% of all government revenue. Not 30% of discretionary spending, 30% of everything the government takes in, before a single dollar is spent on defense, healthcare, infrastructure, or anything else. That creates a fundamental contradiction that has no clean resolution. On one hand, the Federal Reserve needs higher interest rates to fight inflation. That is the textbook response. That is what they are expected to do. On the other hand, higher interest rates make the debt burden increasingly unsustainable. Every rate hike adds tens of billions of dollars annually to the interest bill on $39 trillion in outstanding debt. The system cannot tolerate high rates for long without something giving way. It is structurally fragile at this debt level in a way it has simply never been before. And that fragility is exactly what gold is pricing in, just not in the way most people expect. Because in the short term, markets react to policy expectations. They sell gold when rate hikes are anticipated. But in the long term, markets react to policy consequences. And the consequence of aggressive rate hikes inside a debt-saturated system is always, without exception, the same. Something breaks, the Fed reverses, and everything that was sold in the fear gets repriced in the recovery. Now let me add the global layer, because the domestic picture alone does not capture everything that is building right now. The Bank of Japan is preparing to raise its benchmark rate to 1%, with that decision expected between June 15th and June 16th, days from now. That may sound like a small number, and in absolute terms, it is. But the implications of that move are anything but small. Japan has been one of the largest holders of United States assets in the world, particularly U.S. government bonds. For years, the Bank of Japan's ultra-low rate policy pushed Japanese investors to seek higher yields elsewhere. And the primary destination for that capital was the United States. U.S. treasuries, U.S. equities, U.S. corporate debt, Japanese capital flooded into all of it because yields at home were essentially zero. But if Japanese rates rise meaningfully, that dynamic begins to reverse. Capital that flowed out of Japan in search of yield can start flowing back. The potential scale of that reversal, based on current estimates of Japanese holdings in U.S. assets, is up to $2.2 trillion. That is not a margin call. That is a structural shift in global capital flows of a magnitude that markets have not had to absorb in modern history. Even if only a fraction of that capital begins moving, the effects cascade. Pressure builds on the U.S. bond market. Yields rise further. Financial conditions tighten. And that feeds directly back into the same problem we already identified. Higher yields raise debt servicing costs, strain the federal balance sheet, and accelerate the timeline to a policy reversal. The system gets stressed from the outside at the same moment it is being stressed from the inside. And this is all happening while geopolitical risk remains unresolved and elevated. The conflict involving Iran is now at day 105 with no clear resolution on the horizon. Oil prices are holding in the range of $90 to $95 per barrel, keeping energy-driven inflation alive in a way that a single Fed rate decision cannot address. Energy costs do not respond to interest rate policy the way consumer credit does. They respond to supply. And supply constraints driven by geopolitical instability are not something the Federal Reserve can fix by raising rates. On June 11th, planned strikes were canceled, which caused a short-term dip in both oil and gold. The market read that as a de-escalation signal. But analysts with a clearer view are consistent on one point. This is not peace. This is a pause. The underlying tensions have not been resolved. The conditions that drove oil above $90 are still in place. And as long as they remain, energy inflation stays alive. And with it, the broader inflation pressure that is driving all of this. So step back and look at everything in the same frame. Inflation is rising, not falling. Rate hikes are being priced in, not priced out. The national debt sits at $39.2 trillion, with interest costs growing faster than revenue. Japan is preparing a rate move that could trigger trillions in capital flow reversals. Geopolitical risks are unresolved and actively keeping energy prices elevated. Every single one of these pressures is pointing in the same direction, toward a system that is under structural stress, not one that is stabilizing. Now ask yourself a simple question. In that environment, do higher rates solve the problem, or do they expose it? Because history gives a very clear answer. Every time central banks push too far into a debt-saturated, geopolitically stressed environment, something cracks. It might be the bond market, it might be the banking system, it might be liquidity itself, the moment when the machinery of credit seizes up and the response becomes not a choice but a necessity. When that break comes, the response from every central bank in modern history has been identical. Rates come down, liquidity floods back in, hard assets reprice, and the investors who understood what was actually happening during the sell-off, the ones who held or accumulated while everyone else was reading negative headlines, are the ones who come out on the other side of that repricing in a fundamentally different position. And here is the part of this story that most retail investors are completely missing right now. While individual investors are reacting to short-term price action, watching gold dip and pulling back, institutional players are positioning for long-term outcomes. Central banks globally are still buying gold at a pace of approximately 60 tons per month in 2026. They are doing it at prices above $4,000 per ounce without hesitation, without waiting for a better entry. They are not chasing the dip. They are not watching the charts for a reversal signal. They are accumulating steadily, month after month, at whatever price the market offers them. Think about what that tells you. The institutions that manage sovereign reserves, the entities responsible for protecting a nation's long-term financial stability, are not deterred by a 20% pullback from the January highs. They are not reading the negative sentiment and pausing. They are treating this price level as an opportunity, not a warning. At the same time, major financial institutions have not walked back their price targets. Goldman Sachs continues to maintain its target of $5,400 per ounce for gold by the end of 2026. JP Morgan is projecting gold reaching $6,000 per ounce by 2027. These are not fringe calls from small research shops. These are the publicly stated, formally published forecasts of the largest and most influential financial institutions on the planet. And neither of them is selling into this weakness. They are watching what is building beneath the surface, and they are prepared for what comes next. Now let's talk about silver separately, because silver deserves its own moment in this conversation. Silver has dropped sharply. A 23% decline over the past month is real, and it is significant. If you are watching that number in isolation, it looks like a story of failure. But zoom out slightly and the picture changes completely. Silver is still up 85.42% over the past year. At that performance level, it remains the single best performing major asset class on the planet over the last 12 months, by a significant margin. That is not weakness. That is volatility within a larger pattern of strength. And that distinction matters enormously because the two things can look identical on a short-term chart while being fundamentally different in terms of what they mean for the trend. Silver is more volatile than gold by design. It is a thinner market with a smaller float. It responds more aggressively to shifts in liquidity, investor sentiment, and industrial demand. That volatility cuts both ways. When the trend is up, silver moves faster than gold. When the system is under stress, silver corrects harder and faster than gold. That is not a new development. That is how silver has always behaved throughout every previous cycle. And there is a specific pattern that experienced precious metals investors recognize. Silver often leads gold in the later stages of a precious metals bull market. When the trend reasserts itself after a correction like this one, silver tends to move first and move hardest. The 23% pullback you are seeing right now is not the end of the silver story. It is the inhale before the next exhale. So here is where things actually stand as of today. Gold is down roughly 3% year-to-date and approximately 22% below its pre-war highs from earlier in 2026. Silver is correcting after an 85% 12-month run. Markets are actively pricing in rate hikes. The narrative in the financial press is turning negative. And on the surface, everything looks like a trade that has run out of road. But beneath that surface, the structural pressures are not easing. They are intensifying. The debt load is not shrinking. Inflation is not retreating. Global capital flows are shifting in ways that have not fully registered in prices yet. Geopolitical risks are paused, not resolved. And central banks, the most patient and most informed accumulators in the global financial system, are continuing to buy gold at scale, at these prices, right now. This is not a stable environment signaling a return to normal. This is a pressurized system moving through a familiar sequence. And the moment the Federal Reserve is forced to choose between controlling inflation and maintaining financial stability, between holding the rate line and preventing something from breaking, history tells you exactly what happens. They choose stability. They cut rates. They expand liquidity. They allow inflation to run hotter than target because the alternative, a financial system event, is politically and economically unacceptable. And when that shift happens, gold does not move slowly. It does not drift upward over several quarters. It moves suddenly, the way it always has at the beginning of major repricing events. The people positioned ahead of that moment benefit from the speed of it. The people who waited for the all-clear signal from the headlines missed the majority of the move. So the real question right now is not why gold is falling today. That answer is straightforward. Rate expectations, dollar strength, profit-taking by early institutional holders who bought at $2,000 and are now locking in gains. All of that is mechanical and explainable. The real question is what this fall is preparing for tomorrow, because every previous cycle has followed the same sequence with remarkable consistency. Fear of rate hikes pushes gold down. Policy pressure builds inside a system that cannot sustain it. Something in that system cracks. A bond market event, a banking stress episode, a liquidity squeeze. The Federal Reserve pivots. Liquidity floods back. Gold surges to new highs that leave the previous peak behind. We are now deep into that sequence. The pressure is building from multiple directions simultaneously. The destination of that sequence, the point at which the pivot comes and gold reprices, is not yet visible on the calendar. But the structure of what is happening right now matches every previous instance where that destination eventually arrived. The dip you are watching today may feel uncomfortable. On a short-term chart, it looks like weakness. But historically, this price zone, this moment of negative sentiment, elevated rate expectations, and media narratives turning bearish on precious metals, is exactly where the next cycle's opportunity has always been hidden. Now I want to hear from you directly. Do you think this sell-off in gold is the beginning of a larger and sustained decline? Or do you see it as the setup for the next major breakout, the kind of compression before a significant move higher that this pattern has produced every time it has appeared before? Leave that in the comments. I read them and they shape what we cover next. If you want deeper analysis like this on a consistent basis, you can join the Untold Empire research list. The link is right below this video. It is where we go further than what fits in a video, the data, the context, and the forward-looking analysis that takes more than 16 minutes to properly lay out. And if you want to support the work directly, you can do that by buying me a coffee. Every contribution keeps this research going, keeps the channel independent, and keeps the analysis focused on what is actually happening, not what is convenient to say. Stay sharp, stay informed,